Risk management. Stop loss. Before you start trading in the market, there are so many things to learn. Stop loss is an essential factor when it comes to risk management. Let's see what the meaning is of stop loss and why you should care about a stop loss. What is stop loss? Stop loss can be defined as an advance order to sell an asset when it reaches a particular price point. The Economic Times. Stop loss is used for trading, especially by short-term traders. It is a sell order placed on an exchange, to limit when the stock prices may move against your trade and beyond the losses you are willing to sustain. It is the point where traders sell their stocks and take a loss, or in the trailing stop-loss scenario, take profit. One advantage of stop-loss is that traders don't need to monitor a screen throughout the market hours. You can set a limit of your risk amount, and when it reaches the target price, the stock will be sold. Like setting an alarm clock. For instance, if you have purchased a stock at $50 and you can take a risk until the price goes down to $45 and set the limit. If the stock falls to $45, your shares will be sold automatically. You shouldn't enter any trade without first knowing at what point you no longer want to lose money in a trade. What does stop loss do? The stop loss order reduces the risk exposure to your stock and makes trade easier. The stop loss price depends upon the fluctuation of a particular stock. For example, the price of stock A has fallen or risen by 10%, while stock B has fallen or risen by only 5%. So, the stop-loss price depends upon the volatility of the stocks. Stop-loss helps to maintain discipline while trading in the market. Because it is really important not to get emotional while trading. Some people thought that holding for a while or give another chance for stock recovery from loss, which is a wrong belief and may cause a big loss. Types of stop-loss order. 1. Stop-loss market order. A stop-loss market order is used by investors to sell a stock, when the price of a particular stock is falling down. You can set the limit of stop loss, and if the price of that stock falls, it will sell automatically at the limit price. From the above example, if we can take the risk of $45, you should set the trigger price and exit price. In a market order, the trigger price and exit price is the same. When your stock fall to $45, it will trigger your order on $45, and it will execute your order on the same price or less price in the market. You cannot control the selling price of the market order. If the market is drastically falling, the execution of your order price may be less. But, a market order gives a guarantee to the execution of your stop loss. 2. Stop loss limit order. The first is the trigger price, and another is limit price. Trigger price is the price that triggers your order. On the other hand, the limit price is the last price you want to exit from the market. And you don't want to take risks for less than a limit price. So, let's take the old example. If we take a risk of $45, so in this order the trigger price is $45, and the limit price is $44. In this case, if the price falls to $44, the system will execute the order. But, if the market drastically falls many points and does not stop at your limit price, your order will not be executed, and it will still be in the market. In a limit order, there is no guarantee of execution of your stock in the market. Stop-loss limit order gives the investor to set the limit and execution of minimum price at which the order should be sold. Types of stop-losses. 1. Volatility stop-loss. Volatility stop-loss is a type of stop-loss that indicates changing market conditions. When volatility is high, investors set to stop-loss to reduce the risk. And when volatility is low, there are chances of profit because the price of a stock is not traveling so far. The volatility of stocks is measured by ATR, average true range. The ATR is the market volatility indicator that shows the correct average price of your stock and in which volatility range your stock can travel. The upper range of stock shows the target of your stock, and the lower range shows the stop loss of the stock. The ATR calculation is based on 14 periods. 2. Time-based stop loss. If you are a long-term investor or short-term investor, you always need to take care of the momentum of the price fluctuation. Time-based stop-loss depends upon the moment and low momentum of the stock. You should exit from the stock if it does not move in any direction. A time-based stop-loss suggests exiting the position if there are no movements rather than waiting for a long position. 3. Trailing stop-loss. Trailing stop-loss is a moving stop-loss that is applied when the market moves in the direction of your trade. If your trade is in favor of you, your stop-loss can increase with it. For instance, if you have $50 of stock, If the price will up to $50.10, the trailing stop loss would be $50. But, if the price will fall to $50.05, the trailing stop loss stayed at $50. Exiting trades. Your exit strategy is the first element of the trade you should look at. Excitement may lean you toward entering a trade based on FOMO, or a tip from a friend, but don't be fooled. Consistency is the key to long-term trading. Yes, you can make money day trading, but you still need to remain consistent in that type of trading when it comes to managing risk. Always set a stop-loss based on what you are willing to risk, and most importantly, what you can afford. Going all in your first trade is not going to work well toward consistent growth and long-term outcomes.